Okay, let's go ahead and talk about intercompany debt transactions. Again, parent and subsidiary or subsidiary and subsidiary, they might engage in a number of transactions, one of which is loaning money from one to the other. Now, there are basically two broad categories of transactions we're going to need to worry about. First would be basically the trivially easy, and this is what's referred to as a direct issuance, where one of the two firms issues debt directly to the related party. So big issues bonds and little buys the bonds from big. In this case, there was never a transaction with an external third party, so from a consolidated standpoint, the transaction never occurred. The trivially not easy is what's referred to as constructive retirement. And this is where one of the firms issues the bonds in the open market or to some third party, and then some period of time later, the related party comes along and buys those bonds. So the issuer still has the bond payable and interest expense on their ledger. The bond buyer has an investment in bonds and interest revenue on their ledger, but from a consolidated standpoint, the debt has been retired. So in this case, we're going to have what amounts to, again, what's called a constructive retirement, where from a consolidated standpoint, the bonds have been repurchased and retired at either a gain or a loss. Let's go ahead and take a look at the trivially easy example first of, again, what's called a direct issuance. Let's assume that big owns 60% of little, and on January 1st, 2020, big issues $100,000 of 10% 10-year bonds directly to little at, let's say at 98% of face value. So they're being issued at a discount. Now again, at this stage, big on their ledger, they've got bonds payable, they've got a discount on bonds payable, and at the end of the year, they're going to have interest expense. Little company has investment in bonds, they paid $98,000. At the end of the year, they're going to have interest revenue. From a consolidated standpoint, this debt never existed. It was never sold to a third party. So the easiest thing to do here, let's go ahead and a few more things. Let's assume straight line amortization just to keep life easy. Okay, the safest way to approach this is to go ahead and make up like a shopping list at the end of the accounting period, listing all of the ledger accounts that the issuer and the buyer have related to this bond issue. So, big the issuer they're going to have bonds payable of $100,000. They're going to have a discount on bonds. Now, initially there was a $2,000 discount. Again, they were issued at 98% of face value. That discount is being amortized over the course of 10 years, so by the time we get to the end of the year, $200 of that has been amortized. The remaining discount is $1,980. Similarly, big the issuer has interest expense. Again, the coupon interest is $10,000. The face value times the coupon rate. And there's also $200 of discount amortization. And again, amortizing a discount serves to increase our interest. So interest expense, $10,200. Over on little the buyer's books, they've got an investment in bonds. Now again, they bought these things for $98,000. A $2,000 discount. And that $2,000 discount is again being amortized straight line over 10 years, $200 per year. So at the end of the year, The investment in bonds is up to $98,200. And they have interest revenue of, again, coupon interest plus the amortization. Now, in this case, in the case of a direct issuance, it's really, again, I said it was trivially easy. Basically, what one firm has as a liability, the other firm has as an asset. What one firm has as an expense, the other has as a revenue. And so it's simply going to be a matter of closing the two sets of accounts against each other. So at the end of this first year, we're going to eliminate bonds payable. Just going to tick down the list. We're going to eliminate bonds payable. We're going to eliminate the discount on bonds. And again, discount on bonds is a debit balance account, so to eliminate it, we credit it. And we're going to eliminate interest expense. Similarly, we're going to eliminate the investment in bonds. And we're going to eliminate the interest revenue. Okay, so again, this entry balances. We're simply closing one set of accounts against the other set of accounts. Now, what's going to happen next year? Well, we're using straight line amortization, which is going to make things really simple for us. Bonds payable, still $100,000. Interest revenue and interest expense, still $10,200. Another $10,000 of coupon interest, plus the $200 of amortization. The only thing that's going to be really changing is that we're amortizing that discount. So next year, the discount on bonds will be down to $1,600, and the investment in bonds will be up to $98,400. Again, this transaction has no effect on income. We're eliminating an equivalent amount of interest revenue and interest expense. From a consolidated standpoint, these bonds never existed, and so there shouldn't be any income or loss from this relationship. Okay, just a couple thoughts to leave you with. This assumed that there were no transactions costs. We know that normally when you issue bonds, there are going to be some bond issuance costs, which are deferred and amortized over the life of the bond. How would that affect what we do here? Because in that case, let's say that there was $1,000 of bond issue costs. That $1,000 was paid to our underwriter or to the lawyers or to the accountants or somebody, and when that $1,000 check was written, BIG would have debited unamortized bond issue costs, and that would have been amortized over the life of the bonds. Little doesn't have a matching account, so there's going to be some sort of disconnect there. How do you think that should be accounted for? Secondly, in this case, again, from a consolidated standpoint, these bonds never existed, and so we're basically eliminating all evidence of them from the consolidated financial statements. What if a few years later, again, Big was the issuer, Little was the buyer. Let's say that 3 or 4 years later, Little decides to sell these bonds on the open market. In that case, all of a sudden, a relationship has been established with an external third party, an external economic agent, and so how would that affect the elimination process here? I would encourage you to sit down and think about those issues a little bit. We'll come back later and we'll talk about the constructive retirement.